Planning to go for an interview with a large accounting firm or with a global investment bank? Then these are some basic terms that you ought to know about options. Top option terms you better know if you're planning to go for that interview so that you're prepped up with all the research material that you ought to know at the interview. Hi everybody, I'm your learning partner Sushila Hariharan, and if you're interested in a career on fund accounting, corporate actions, trade life cycle and OTC derivatives, please subscribe to my YouTube channel, join my LinkedIn fam as we provide content-centric, research-focused material and videos on anything related to these four fields. The first term is to understand the basics of an option. Oh my, an option is basically a derivative product, okay? Like all derivative products, its price is derived from the price of the underlying asset. So you can have an Infosys option, you have an Infosys stock, you have a USD Euro option, you have a USD Euro stock, okay? The derivative product itself is traded in a separately traded segment on stock exchanges, or it could even be OTC derivatives. Option gives the buyer. The buyer, in the case of an option, is also called as the holder of the option or the owner of an option. The right to do what? Obviously, the right to exercise the option only if it is profitable for her, because she's a sensible investor. She's going to exercise the option only if it is profitable for her. If, on the other hand, it is not profitable for her to exercise the option, the buyer has a right to lapse the option. Don't exercise the option. If you don't exercise the option, this is known as allowing the option to lapse. Okay? So these are the basics of an option. This takes us to the second term over here called as a call option. A call, okay? Remember the term call. It comes very often in finance and markets, in bonds, in derivatives. Basically, the call is a right to buy, okay? Or right to invest. So the call option gives the buyer the right to buy the underlying asset. So the trader could be having a long position in a call option, in a foreign exchange call option. So it gives the buyer the right to buy the underlying foreign exchange. Okay. If the trader has a long position in a equities call option, then he has a right to buy the underlying equity instrument. So the call option gives the buyer the right to buy the underlying asset. As opposed to call options, we have put options. This is the third terminology that we're learning in this video. The put option gives the buyer, now this gets a little confusing, okay, to sell the underlying asset. So if you are the buyer, remember, all buyers will have a long position, correct? But here you're having a long position in the derivative. Yeah, but there's a right to sell the underlying. So you're having a long position to short the underlying. Okay, so this is a little confusing for some of the participants. So just don't get confused when the term put option comes in, because clearly it is attempted to confuse us at the interviews, which normally happens because you're already under so much of stress at the interview, you're already under so much of pressure. Don't get pressurized. Be very clear, be very concise about these concepts. So the put option gives the buyer the right to sell the underlying asset. So now here we're going to now go on to the fourth term, which will talk about the option buyer. If everything is the buyer, then let's take a look at what are these rights that the buyer has. The buyer is an entity that has the right to exercise the option. Okay. So the buyer is also called as the owner or holder of the option, and they have a right to exercise the option and take delivery or give delivery of the underlying asset. The buyer has all the rights to exercise or allow the option to lapse. If the buyer does not exercise the option lapses worthless. Okay, this is called as the rights that the buyer has. All the rights. That is basically the rights of performance. On the other hand, the option writer, who is a counterparty to an option buyer. also known as the option seller, but we will always use option writer because in finance we use so many terms for the same thing, like par value, face value, nominal value, etc. Similarly over here, option writer, seller, shorter, okay, they have a short position in the underlying asset. So the option writer does whatever the option buyer wants. They have no rights, they only have all the obligations under the option. Okay, so think of this as two counterparties. One is heavily long in the trading position, one is heavily short on the trading position. The entity that is long on the trading position has all the rights, the entity that is short on the trading position has all the obligations. This takes us to the sixth term, which is premium. Obviously, there's going to be a price that's going to be extracted by the writer, right? I mean, he's surrendering all his rights. He's having all the obligations, he's surrendering all his rights. But in finance, there is no such thing as a free lunch. In fact, even in life, there is no such thing as a free lunch. So in derivatives too, premium is charged by the writer. This is called as the price of the option. The premium is a price that is always paid by the buyer to the writer. Okay? Irrespective of whether the option is exercised or not, because the premium is collected on the trade date itself. Consider premium to be a sunk cost. A sunk cost is a cost which many investors take in just to be able to do something, right? So if a buyer wants to take a long position in a call or a put option, they must pay the premium because it's a price that they're getting literally for taking over the seller's rights. Okay, so hence premium is always collected by the writer of the option. Okay, that brings us to the seventh term, option expiry. Oh my god, what a word to use, expiry, expiration, and all that. Sounds quite morbid and dead like. Yeah, but that's the term that's normally used in markets. So let's take a look at that. Any contract that expires on a particular date is called as expiration date. On exchanges where the option is traded, the expiration date or the expiry date is mentioned on the contract and it's very standardized. In OTC derivatives, it is customized between both the counterparties to the trade. The option contract must be settled before or on expiry. It cannot be extended beyond the expiry. So in options, there is mandatory settlement of all trades that take place. The option expiry in exchange traded derivatives, ETD, that is called as exchange traded derivatives or listed derivatives, expiry is determined by the exchange on which it is traded. The eighth term, an basis of the option expiry date, we have three types of options. American option is the first one that can be exercised any time before expiry. So you can trade today, pick up a December 2023 option, and it can be exercised any time before expiry. Most American options are cash settled. Cash settled means only the profits and losses are exchanged between the traders. The ninth term is European option. A European option is an option that can be exercised only on expiry. Okay, it cannot be exercised anytime up to expiry. It can be exercised only on expiry, and most stock options are European options. Now we have a new category of OTC derivatives which offer multiple settlement dates. These are called as Bermudan options. And Bermudan options are basically European options with multiple settlement dates so that the trader can then decide to settle it on any specific date. They are mostly OTC traded, okay? Not so much exchange traded as we would like them to be, but they're mostly OTC in nature. The 11th term, break-even price. Break-even price is the premium plus the strike price. Premium is paid by the buyer. Who receives the premium? The writer. So if the break-even price is achieved, then the buyer will exercise the option. This term is very important to understand the moneyness of the option. Moneyness of the option means understanding whether the option is in the money, at the money, or out of the money. And in the money option is the 12th term in this video, is an option which is profitable to exercise. Now you tell me, who has the right to exercise? The buyer. So therefore, we are going to look at moneyness only from the buyer's point of view, because the writer has to do whatever the buyer wants. So an option which is profitable to exercise for the buyer is called as an in the money option. In call options, if the spot price is greater than the strike price, then the buyer will definitely exercise the option, right? Therefore, in such a situation, it is called as an ATM option. In put option, if the spot price is less than the strike price, surely, why would you exercise the option? Yeah, because you can sell it in the market. You can. Why would you sell it in the market? Because you can sell it under the option. This is called as in the money option. The 13th one is an option that is not profitable for the trader. This is called as OTM option, out of the money option. An option which is not profitable to exercise. Such an option which is not profitable for the trader to exercise is called as an out of the money option. They allow the option to lapse. For example, in a call option, if the spot price is less than the strike price, there is no way the buyer will exercise, right? Why will he buy at the strike price? When he can pick it up in the market at the spot price. Therefore, such an option is called as a OTM option. In put options, if the spot price is greater than the strike price, then the buyer of the put option will definitely not exercise, right? He can sell it in the market at the spot price, where his yield or his returns will be much more than the option price. And finally, an ATM option, at the money option. An ATM option is an option in which the strike price and the spot price is the same, or the break-even price is achieved. It is neither ATM nor OTM, and therefore the buyer is indifferent towards exercising or not exercising the option. Cash settlement. Cash settlement is when settlement mechanism where only the profit and losses is exchanged between the two traders or between the two counterparties. This basically means there is no exchange of the underlying asset and only the P&L is captured. What about physical settlement? A physical settlement is when underlying asset is exchanged and cash is paid for taking that underlying asset. The transactions are then settled at the traded price. Okay, very rare in exchange traded derivatives, but quite common in stock exchange, in OTC derivatives as well. Thank you so much for listening into this video, and hit that subscribe button if you like the content.